Where's the tension right now between the market and where the Federal Reserve is?
I think we're all going to be really focused, obviously, on the language coming out of this meeting. It would be extremely surprising and incredibly disappointing for companies and for equity investors if the Fed didn't signal they had confidence in the economic expansion, and that was inconsistent with what they are experiencing in their business. Strong top-line growth and what we expect to be continued next couple quarters of strong earnings.
Dan Morris?
Well, I think we've had a situation very similar to this over the last couple of years, where if you look at what the Fed has said it's going to do in terms of interest rate hikes and what the market is priced in, there's always this big gap, right? We've had this repeatedly. And in the end, it's always turned out that the market was wrong. So I think we need to appreciate it is likely, in our view, the same again. The market is underestimating what the Fed is going to do. We think there's going to be 4 hikes between now and the end of next year. And we're going to have to anticipate what the effects are going to be on the market when it realizes that's going to happen.
A couple of years ago, Steve, we got used to the market coming down towards the Federal Reserve, or rather the Federal Reserve coming down towards the market. Do you think this time is different going into 2019?
Good question, Jonathan. We don't think it's different, and it's actually good timing to be here today. We've just published our global outlook for Q4, and key theme we would focus on here is we think a lot of what the Fed's going to do is already priced in, and therefore we don't see huge moves in the bond market. But I think one of the key moves we're likely to see is in currencies. So our strong view is that the dollar is actually likely to weaken from here through to the end of the year. We're calling for 120 in euro dollar by the end of the year. And the rationale for that is largely that the dollar has been overvalued and a lot of the rate hikes were already priced in.